You have $1.5 million in your 401k. You're 52 years old and ready to retire. Your advisor tells you, if you take that money out, you'll pay a 10% penalty plus ordinary income tax. So you decide to work another 7 years. But there's a strategy the IRS explicitly allows that lets you legally bypass this wall. It's called the Roth Conversion Ladder. Today, I'm going to break down every step of this strategy, what the IRS rules actually say, how to execute it, and most importantly, whether you should use it at all. Quick disclaimer. This content is for educational purposes only. It's not personal tax or financial advice. Everyone's situation is different. So please consult your CPA or financial advisor before making any decisions. If you haven't watched the last episode, here's the quick recap. We proved with 30 years of real math that if you have a match, take the 401k match first. Then max out the Roth IRA. But that left one question unanswered. Once the money is in, how do you get it out early? Today is the answer. Let's go. Part 1. What's the problem? Let's start with the problem. The IRS rule. If you withdraw from a traditional 401k or IRA before age 59 and a half, you pay a 10% penalty on top of ordinary income tax. Let's say you're 52, retired, with $1.5 million in your 401k, and you need $40,000 a year. If you just withdraw $40,000 directly, 12% income tax is approximately equal to $4,800. 10% penalty equals $4,000. You get is approximately equal to $31,200. That's 22% gone before you even spend $1. Most people hear that and give up. Fine, I'll work another 7 years. But the Roth Conversion Ladder is designed specifically to solve this. Key clarification. This example shows the cost of a direct withdrawal. The Roth Ladder's purpose is to eliminate that 10% penalty. You still pay income tax. You just pay it in the year you convert, not the year you withdraw. Part 2. What is the Roth Conversion Ladder? The Roth Conversion Ladder works in 3 simple steps. Step 1. Roll over your 401k to a traditional IRA. Then convert a portion to a Roth IRA each year. The conversion itself doesn't trigger the 10% penalty, but you do pay ordinary income tax on the converted amount. Step 2. Each conversion has its own independent 5-year clock, starting on January 1 of the year you convert. Step 3. After 5 years, the converted principal can be withdrawn tax-free and penalty-free, regardless of your age. Why is it called a ladder? Year 1 conversion unlocks in year 6. Year 2 conversion unlocks in year 7. Year 3 conversion unlocks in year 8. Each year, a new rung matures, just like a ladder. Key distinction. This 5-year rule applies to converted principal only. If you want to withdraw earnings from your Roth IRA, you need to meet both the 5-year account rule and age 59 and a half. But in the ladder strategy, you're only touching the principal, which is all you need. Part 3. How to execute it. Let's walk through this with a real example. Case study. Mike is 52 years old with $1.5 million in his 401k. He wants to retire now, not wait until 59 and a half. Step 1. Roll over the 401k to a traditional IRA. Most 401k plans don't allow clean partial conversion tracking. Roll the entire 401k to a traditional IRA using a trustee-to-trustee transfer. No tax, no penalty. Step 2. Convert annually to the Roth IRA. Convert a portion each year. Let's say Mike converts $40,000 per year. Age 52, 2026. Convert $40,000, unlocks 2031. Age 53, 2027. Convert $40,000, unlocks 2032. Age 54, 2028. Convert $40,000, unlocks 2033, Age 55, 2029. Convert $40,000. Unlocks 2034. Age 56, 2030. Convert $40,000. Unlocks 2035. Each conversion clock starts on January 1. A conversion done in December 2026 matures on the 1st of January 2031. Step 3. Pay the tax on conversion. This $40,000 conversion is treated as ordinary income in 2026. And here's the key. The conversion itself does not trigger the 10% penalty, but you do have to pay both federal and state income tax on it. Let's say Mike has no wage income in retirement. He converts $40,000. He takes the 2026 single standard deduction of $16,100. That leaves him with about $23,900 in taxable income. Now let's run the federal tax. The first $12,400 is taxed at 10%. That's $1,240. The remaining $11,500 is taxed at 12%. That's $1,380. Add them up. The federal tax comes to roughly $2,620. But that's not the whole story. You also have state tax, and this one depends entirely on where you live. Let's use California as an example. California taxes your total income. There's no standard deduction, so the full $40,000 is taxable. At California's 2026 rates, the tax comes out to about $960. So if Mike is in California, the total tax bill is $2,620 federal plus $960 state. About $3,580 total. And here's a critical point. Pay this tax from an external account. Never withhold it from the conversion itself. If you do, the IRS treats that withheld portion as an early withdrawal, and you'll trigger that 10% penalty. Also worth noting, if Mike lives in a no income tax state like Florida, Texas, or Washington, his state tax is zero. His total tax is just the $2,620 federal. And this entire calculation assumes Mike has no other income. No wages, no dividends, no interest. If he does, the tax goes up. Step 4. Wait 5 years. The 2026 conversion matures on the 1st of January 2031. Step 5. Withdraw tax-free and penalty-free. Once the 5 years are up, that converted principal can be withdrawn. No tax, no 10% penalty. Part 4. 3 traps you must know. The ladder is a great strategy, but there are 3 traps that can sink you if you're not careful. Trap 1. Each conversion has its own 5-year clock. The IRS rule is clear. Every single conversion has its own independent 5-year clock. 2026 conversion. Unlocks 2031. 2027 conversion. Unlocks 2032. 2028 conversion. Unlocks 2033. It's not open a Roth IRA and wait 5 years. You must track each conversion separately. Trap 2. The IRS does not track this for you. The IRS requires you to file Form 8606 every conversion year. But they do not track your conversion dates or amounts for you. You must keep your own records. The date, amount, and unlock date for every single conversion. Keep a permanent spreadsheet. Save it forever. Trap 3. Large conversions can trigger IRMAA. This is the hidden tax most people miss. In 2026, if your Magi exceeds $109,000 single or $218,000 married, you trigger IRMAA, an additional Medicare Part B premium. Roth conversion income counts toward Magi, and there's a 2-year look back. Your 2026 conversion income affects your 2028 Medicare premiums. If you're a single filer and your conversion pushes you just $1,000 over $109,000, Your Medicare Part B premium could increase by about $81 a month, roughly $972 per year. Part 5. Tax comparison. Decision framework. Let's run the numbers. Direct withdrawal at 52. Mike takes $40,000. After paying about $4,800 in income tax and a $4,000 penalty, he's left with just over $31,000. Now, the ladder strategy. Convert $40,000 at 52. Pay roughly $2,600 to $3,500 in tax depending on your state. Wait 5 years. Then withdraw everything tax-free and penalty-free. That leaves Mike with about $36,000 to $37,000. A savings of roughly $26,000 to $31,000 over 5 years. That's the power of avoiding the penalty. So who should actually use the Roth ladder? And who should skip it? Here's who it fits. First, you're planning to retire before 59 and a half. That's the whole point. Second, you have a bridge fund. Money sitting in a taxable account or Roth contributions that can cover your living expenses for the first 5 years. Third, you have little or no wage income in early retirement, so you're in a low tax bracket. Fourth, you expect your tax rate to be higher later on. And fifth, you're okay with a 5-year lockup period on the money you convert. Now, who should not do this? If you don't have a bridge fund for those first 5 years, don't even consider it. If you're already 59 and a half or older, you don't need the ladder. You can already access your money penalty-free. If you're in a high tax bracket right now, converting would just trigger a huge tax bill. And if you need the money within 5 years, this strategy is a non-starter. Because that money is locked until the clock expires. Part 6. The first 5 years. The bridge fund. Most people ask, if the converted money is locked for 5 years, how do I live during the first 5 years? This is the biggest hurdle of the strategy. 3 sources for bridge funds. 1. Taxable brokerage account, stocks, ETFs, most flexible. 2. Existing Roth IRA contributions. Withdraw anytime, no tax impact. 3. Short-term treasuries or money market funds. Safe, currently yielding around 4 to 5%. How much do you need? Mike needs $40,000 per year. 5 years equals about $200,000. If he has $200,000 to $250,000 in external accounts, he can easily bridge the 5-year gap. The simple rule: no bridge fund equals no ladder. The strategy doesn't work without it. Part 7. Alternative strategies comparison. The ladder isn't the only option. You may have heard of these 2 alternatives. Alternative A, 72T, SEPP. 72T lets you take substantially equal periodic payments without the 10% penalty, but it locks in your withdrawal amount. If you break the schedule, the IRS retroactively applies the 10% penalty plus interest to every prior withdrawal. The ladder is much more flexible. You can skip a year if you don't need the money. Alternative B, Rule of 55. If you separate from service in the year you turn 55, you can access your current employer's 401 penalty-free. But here's the catch. You must be 55 plus, and it only applies to that specific 401. If you leave at 52, this rule doesn't help you. Summary and decision checklist. Let me give you a simple 4-step framework to decide if the Roth ladder makes sense for you. Step 1. Are you planning to retire before 59 and a half? If not, you don't need this strategy. But if you are, keep going. Step 2. Do you have a bridge fund? That's money in a taxable account or Roth contributions that can cover your first 5 years of living expenses. If you don't, build that up first. If you do, move to step 3. Step 3. Will your tax rate be lower in those early retirement years than it is now? If yes, the ladder is a great fit. But if not, be careful. Converting at a higher tax rate defeats the purpose. Step 4. What about state tax? If you live in a high-tax state, make sure you run the numbers. But if you're in a no-tax state, the latter becomes a much easier decision. Take it step by step, and you'll know exactly whether this strategy is right for you. Before you leave, let me give you 3 things you can actually do this year. First, check if your 401k allows a rollover to a traditional IRA. Most do, but it's worth confirming. You can't start the ladder without this step. Second, figure out your effective tax rate for your first year of retirement. Add your federal and state tax together. That number tells you how much you can convert each year without jumping into a higher tax bracket. Third, take a close look at your external accounts. Your taxable brokerage, savings, any Roth contributions you already have. That's your bridge fund. It determines whether you can make it through the first 5 years. Do these 3 things, and you'll know exactly where you stand. I'm Gino. Next episode, we're covering the Backdoor Roth IRA. What to do if your income is too high to contribute to a Roth IRA directly. See you then.